Hey YouTube, this is Zach with Achilles Financial, and today I'm going to be talking about Nvidia. And the reason we're specifically targeting Nvidia is because this Wednesday, November 16th, they are going to be announcing earnings after hours. So that's going to be at 5 p.m. Eastern Time is when they're actually going to have the call. Now, Nvidia is in a weird spot this year, and this is a company that I have been following closely and reporting on this channel on for a number of years at this point in time. One of the cool things about Nvidia is how quickly that they've been able to grow and how quickly they've been able to grow profitably. However, at the end of Q2, or right before they announced their Q2 results, they actually did a special announcements where they highlighted that due to the regulatory environment and the pressure they had received from the US government, they were no longer allowed to sell their high-end graphics processing units, or GPUs, to China. Now, at this point in time, or at least in 2022, year to date, Nvidia currently sells those GPUs more to Taiwan and China than they do to the United States. So at this point in time, in terms of if we were to break out Taiwan, if we were to break out kind of all other countries grouped together, and we were to break out the United States would be the smallest portion of that growth. Now, that doesn't necessarily mean that that is limited to who ends up receiving the final product, because Nvidia does have the capability, or their chips are in a lot of different products. However, in terms of that initial sell, there is a large percentage of overall sales that are non-US bank based. Now, because of that, we did see a heavy decline. Keep in mind that this was happening at the same time that the overall stock market was declining, in particular tech as well, due to higher interest rates and a uglier and uglier looking macroeconomic environment. So what we're looking at now is we're coming on the upswing from that. And in particular, if you look at the 3-month breakout, you can see that they heavily benefited from that rip that we saw last week. And the stock is now well off of its lows, nearly 50% from those lows where we saw it drop to as low as $108 a share. And now we're currently sitting at $163 a share. So what does that mean for the stock on a go-forward basis? Well, at this point in time, I continue to not view this as a favorable buy, and that's largely due to the fact that I expect interest rates to continue to rise. I also expect, in line with their earlier guidance, that they are not going to be growing as quickly as they have previously. You can see that that growth or lack of growth has already eaten into their price to earnings ratio, which is showcasing that they are less profitable currently than they were at this time last year. We can actually look at that in terms of the fundamentals page here and look at their income statement. So on a quarterly basis, keep in mind Q4 is their most profitable quarter, and it does tend to trend down, but even year over year, you can see that revenue is actually declining, where previously this is a company that has been growing more than 50% with more than 50% gross margins. There's not another company in the world that is doing as well as they are in terms of their growth at the scale that they are doing it. Now, that being said, based off of a $6.7 billion revenue in Q2, they only walked away with total profit of $656 million. So the company is not insolvent. They're not worried about profitability. But if you compare that to the quarter prior, where they had $8.2 billion in revenue and they walked away with more than $1.6 billion in profit, it is in a very different spot now than it was in Q1 as well as Q4 of last year. So there are a lot of moving parts associated with Nvidia. All in all, I don't think that the company itself is going to be in trouble. I think it's a great long-term hold, but I think that I'll be able to get it at a lower price in the future. Now, keep in mind, this is just my opinion. But at this point in time, if you look at the company over the past 5 years, they have been on a monumental streak. Now, at this point in time, they are still more than double, and at this point in time, triple the heights prior to COVID. So you can see the highs prior to them was about $73, $74 a share. And previously, at the end of 2021, the stock was as high up as $346 a share. So we're well off the highs, but we're also well off the lows, the pre-COVID highs. And that's what's giving me concern. At this point in time, we never hit those lows. And as such, I still think that there's a potential to get back to that point in time. Overall, the chart looks good, but I don't think that we're back into kind of the sub $100 range, which would put it more in line with what I would expect to see. Now we can look at overall valuations, and the website I'm using for all of this analysis is TD Ameritrade. They're the broker that I use. I would highlight that from an industry perspective, Nvidia continues to outperform by more than double, by price to sales, nearly double. And then in terms of the growth rates, they are actually, if we look at the revenue growth, slowing down, but revenue growth on a trailing 12-month basis, this has consistently been north of 50%. So all in all, we're expecting this to continue to decline, and hopefully not to the extent of what we saw in Q2, which was a 72% decline. So that being said, there is a lot not going well from a macroeconomic outlook. We've got higher inventories, which means that they're going to have to take a hit on prices, causing, again, overall net income to decline because gross margin is declining. This is something that's been historically north of 50, 55, and one quarter north of 60% gross margins. So what we need to watch is, what is the Q4 outlook going to be? Right now, Q4 revenue growth, or current revenue growth, is dropping dramatically. Again, the company also had a killer year last year, so this is still taking in mind the scale of the company, but they have to be able to grow, and they need to be able to grow profitable. So again, gross margins still north of 60%. Does this stay there? Net margins, does this stay there? So between that and the growth rates, we really need to be eyeing this and determining, is the company going to continue to perform? At this point in time, anything in big tech, I still tend to have a bearish view associated with it. So I'm expecting this to go down. And my current plan is to short into earnings by buying puts on the stock dated to a farther out point in time of this calendar year. If you want to take the opposite side of that trade and you own shares, my recommendation would be to sell covered call, because the current options pricing is very favorable for the stock. And so if you think that I am wrong, you can sell a farther out covered call and be able to take advantage of some of that premium. All in all, I think the company is great. I think management is excellent, but based on the broader macroeconomic environment and where the stock is right now, it's not one that I personally want to own, and I am actively going to be looking at it from a short perspective going into the earnings report. That being said, if I'm wrong and if the stock price continues to go up, I'm not going to actively chase this. However, if it were to decline and get back into that $100 range, that would be kind of where I would be targeting a setup. So if you find this content helpful, please let me know by leaving a like and subscribe. And if you've got feedback for me, let me know in the comment section down below. Thanks. Talk to you later.